Over the past few modules, we have been talking about various measures and financial performance parameters that help us determine the valuation of a company. In this module, we shall put all this to action and determine the valuation of a company using various methods. Along with determining the valuation of a company, we would also look at how two companies can be compared based on their valuation. Along with this, we would also look at how two companies can be compared on basis of other financial performance parameters apart from valuation. The method that we would be using to determine the financial performance of a company and thereafter determine the valuation of a company is ratio analysis. Using this method, we can value companies based on their financial performance as well as their shareholding pattern. This method can be divided in three categories. First is direct valuation ratios, which include ratios like earnings per share, price to earnings ratio, dividend per share, price to sales ratio, and price to book value ratio. Second is leverage ratios, which include ratios like debt to equity ratio and debt ratio. The third is liquidity ratios, which include ratios like current ratio and quick ratio. We would be covering these ratios in the order that we have mentioned them here. Valuation ratios are those ratios that are most commonly used by investors to determine the attractiveness of a stock or company. Valuation ratios take into account the fundamentals of a company while determining its valuation. Fundamental parameters include earnings, dividends, revenue, book value, among others. These are certain concepts that we covered in our previous modules, and therefore it would be easy for you to now learn more about valuation ratios as well as determine valuation ratios. The first valuation ratio that we are going to look at is EPS or earnings per share. Earnings per share or EPS gauges the profitability of a company and the amount of profit that is allocated to each outstanding share. This ratio is determined by two factors: profit after tax and number of outstanding shares. Therefore, EPS is equal to profit after tax or PAT divided by number of outstanding shares. Companies with higher earnings per share or EPS ratio are more profitable and therefore are more preferred by investors. EPS is measured both on an annual as well as on a quarterly basis, and a growing EPS is always considered a good investment. Let us take the case of ABC Limited and XYZ Limited to understand this more in detail. As we can see, in the case of ABC Limited, over a span of 3 financial years, the EPS grew from 3.5 in 2016-17 to 4 in 2018-19. However, in the case of XYZ Limited, things were slightly more volatile. The EPS was at 5 in the financial year 2016-17. It fell down to 0 in the financial year 17-18 as the company became loss-making, and it grew back to 6 in the financial year 2018-19. These are cases in which gauging becomes really tricky. Therefore, it's imperative to understand the reasons behind the fluctuation in the case of XYZ before gauging which company is a better stock to invest in. The second valuation ratio that we are going to look at is PE or price to earnings ratio. PE or price to earnings ratio depicts the relationship between a company's market price per share and earnings per share. Therefore, PE is equal to market price per share divided by earnings per share. PE ratio helps us determine how much the market is willing to pay per rupee earning of the company. PE ratio also helps us determine how the company is valued in its industry as well as relative to its competitors. Let us take the case of ABC Limited and XYZ Limited to understand this more in detail. As you can see from the table below, we have taken a case where we have taken 3 months from the same financial year in order to enable our comparison for this ratio. As one can see, the market price of ABC Limited went from 35 in April 2019 to 48 in June 2019. Therefore, the PE of this company shot up from 10 in April to 13.7 in June. Similarly, in the case of XYZ Limited, the PE went from 12 in April 2019 to 14 in May 2019, only to come down to 8 in June 2019. This was due to market price fluctuation. As we have taken the same financial year in both cases, you can see that the EPS for each company stands fixed and same. If these two were the only two companies operating in the industry PE would be 11 for the month of April, 12.7 for the month of May, and 10.85 for the month of June. Therefore, we can now draw our conclusions. ABC Limited was valued lower than industry in both months of April and May, as its PE was lesser than industry PE, while it was also valued lower than XYZ Limited, its competitor in this case, for both these months, as its PE was lesser than the PE of XYZ Limited. However, for the month of June, ABC Limited was valued higher than industry average, as its PE was greater than industry PE, while it was also valued higher than XYZ Limited, its primary competitor, as its PE was greater than the PE of XYZ Limited. It's important to note that the PE of a company fluctuates every minute or every second as the market price of that company keeps fluctuating. After EPS and PE, let us come to our third valuation ratio, dividend per share. Dividend per share reflects the amount that the company has paid back as dividend per each share held by its shareholders. Dividend reflects that portion of a company's profits that the company decides to give back to its shareholders. Dividend per share or DPS is equal to total dividend paid divided by number of outstanding shares. Earnings and dividend of a company are different, as the company may choose to retain a part of its earnings and not give them to shareholders in order to fund its future growth activities. Let us take the case of ABC Limited and XYZ Limited to understand this more in detail. As you can see, we have added two columns to the same table that we used while studying EPS in order to study the concept of dividend per share. These two columns are of dividend and dividend per share, which is DPS. As we can see, both companies have given out dividend in each of the financial years that are mentioned in this table, with one exception. XYZ Limited did not give out any dividend in the financial year 2017-18 as it was a loss-making enterprise at that time. The difference between profit after tax and dividend is the component of earnings that the company has decided to retain back in order to fund its future growth activities. This retention also causes the subsequent difference between earnings per share and dividend per share. It is important to note that generally a high dividend company is valued higher. However, this is a very subjective call, as the DPS or dividend per share of a company should not be that high also that it has stopped completely investing in future growth activities. The next valuation ratio that we are looking to study is price to sales ratio or P2S ratio. Price to sales or P2S ratio determines the relationship between the market capitalization and total revenue of a company. As a result, price to sales ratio is equal to market capitalization divided by total revenue of a company. It is generally used in cases where earnings of a company are missing. A lower price to sales ratio is generally considered healthier, as it keeps a check that the company is not getting overvalued in case of absence of earnings. However, we have a suggestion. You are using the price to sales ratio. Using enterprise value instead of market capitalization can help you understand and gauge a company better while using the price to sales ratio, as enterprise value takes into account debt. Let us take the case of ABC Limited to understand this more in detail. As you can see, in both cases depicted here, we have taken market capitalization, debt, and sales to understand and study the price to sales ratio. In the first case, when price to sales ratio is solely determined by market cap, we can see that the price to sale ratio of ABC Limited is going down, signaling a healthy measure. In case 2, where price to sales ratio is determined by enterprise value, we can see that the price to sales ratio of ABC Limited is going up, signaling an unhealthy sign. Basically, the company here is becoming more reliant on debt to achieve its sales. In case 1, when the price to sales ratio is calculated by market capitalization, this is not factored in, and therefore the price to sales ratio is giving us a healthy measure and a healthy trend. In case 2, by using enterprise value, we have factored in the debt component, and therefore the price to sales ratio is giving us a more realistic and correct measurement, as it's showing an unhealthy sign of relying more and more on debt in order to achieve revenue. Our final measurement to study valuation is the price to book value ratio, or P to BV ratio. Price to book value ratio, or P to BV ratio, depicts the relationship between the market price of a company and its inherent book value. Therefore, price to book value ratio is equal to market price of a company divided by book value per share. Book value per share is simply net worth of the company divided by number of outstanding shares. Like in the case of PE, it is important to use price to book value ratio to compare companies within the same industry. A price to book value ratio lesser than 1 indicates undervaluation. However, this is mostly in cases where some negative news is associated with the company. After looking at valuation ratios as part of our study on financial ratios, let's shift and extend our focus on leverage ratios. Leverage ratios are simply financial indicators that look at how a company is financing its capital through a mix of debt and equity. Another primary focus of leverage ratios is to look at the solvency of a company and whether it's capable of meeting its financial obligations. The primary reason why you need to know leverage ratios is so that you can identify companies which have an optimal mix of debt and equity as part of their capital structure, while also focusing more on companies that have lower debt. Few concepts that help us arrive at leverage ratios include debt, equity, and total assets of a company. The first leverage ratio that we will look at is debt ratio. Debt ratio is simply indicative of the proportion of a company's assets that are financed through debt. Therefore, debt ratio is equal to total debt divided by total assets of a company. Here, debt includes both short-term debt and long-term debt. A debt ratio greater than 1 indicates that there is more debt in the company than the assets of that company and is generally considered as unhealthy. Debt ratio should also be compared of two companies that are in the same industry. This is because some industries like utilities are inherently more capital intensive, and that's why they need greater debt, than some like technology, which are inherently lesser capital intensive and therefore require lesser debt. After debt ratio, the second leverage ratio that we will look at is debt to equity ratio. Debt to equity ratio simply measures the extent to which the company is leveraged. Debt to equity ratio is equal to total debt divided by shareholders' equity. Here, total debt consists of both long-term debt and short-term debt. Generally, a lower ratio is considered healthy, as this means that there is more proportion of equity in the company as compared to debt. After studying valuation ratios and leverage ratios as part of financial ratios, we will now study at the third kind of financial ratio, liquidity ratios. Liquidity ratios are simply measures of how quickly is a company able to pay off its debt obligations. There are two critical concepts that we need to understand as part of our study on liquidity ratios. The first concept is that of current assets. Current assets are those assets that can be converted to cash within a period of 1 year. This includes assets like credit sales, cash in hand, as well as inventories. Current liabilities is the second concept that we need to understand to further study liquidity ratios. Current liabilities are those liabilities that the company needs to pay off within 1 year. This includes credit purchases and taxes, among others. The primary difference between liquidity and leverage ratios is that liquidity ratios look at a company from a more short-term perspective. The first liquidity ratio that we are going to study is called current ratio. Current ratios is indicative of the amount of a company's current assets that are available to pay off its current liabilities. Therefore, current ratio is equal to current assets divided by current liabilities. Current ratio also measures a company's short-term solvency, and a higher measure of current ratio generally indicates that a company has enough assets to pay off its current liabilities. Therefore, a higher current ratio is considered better. However, there's a catch here. A very high current ratio, say of around 6 or 7, would mean that the company is generating enough cash but is not able to deploy it in order to grow or generate further profitability. Therefore, an extremely high current ratio like that of around 6 or 7 is considered unhealthy. Like current ratio, quick ratio is also indicative of a company's current assets that are available to pay off its current liabilities. However, the primary difference between current ratio and quick ratio is that quick ratio does not take inventory to be part of a company's current assets. Therefore, quick ratio is equal to current assets minus inventories divided by current liabilities. This ratio considers that inventory may or may not be fully sellable and therefore convertible to cash within 1 year. Generally, a higher quick ratio is healthier for the company, and therefore a quick ratio greater than 1 is healthy.